Good morning, and let us start this death of a partner which does not come by giving any notice. As you know, retirement is voluntary, but death is compulsory. So, death will not wait for anything, that is why it is uncertain. Retirement can be planned, but death cannot be planned. So, all at a sudden some special points crop into our discussion, that is, in addition to the problems which we have already faced in case of retirement of a partner, these two special points we have to be very careful. What are they? Number one, ascertainment of deceased partner share of profits. And number two, treatment of life insurance policy. Unlike in case of retirement, when the retirement of a partner usually takes at the beginning or at the end of the year, death may come to any partner at any time. So, we will be taking one example to explain how this calculation of partner share of profits will be there. Suppose A, B, C share profits and losses in the ratio of 3:2:1 and C expires after 73 days of the commencement of the current year. So, how he will be taking his share of profit up to the date of his death, that is the special point here to be discussed. So, it may be based on the basis of period, or on the basis of sales. Suppose on the basis of period, how it will take place. Suppose last year profit was 40,000 or say 42,000. Last year profit was 42,000. So, this year, although we do not know what will be the exact amount of profit at the end of the year when we will prepare the profit and loss account, but we can estimate or we can expect or we can assume that the same profit will be continued this year also, and we will be having an annual profit of 42,000. But in 73 days, what is the proportion of this profit? Into 73 by 365. That means 1/5 of this will be the profit so far as his profits will be concerned. So, it will be 1/5 of 42,000, that is 1/5 of 42,000 divided by 5. It will be 8,400. Again, the entire 8,400 does not belong to C alone. C will be getting only C share is equal to 8,400 into 1 by 6, because his share is 1 by 6. So, it will be 1,400. For this 1,400 we can pass the entry. If it is not on the basis of time, but on the basis of sales also we can do. On the basis of sales we can determine. How? Suppose last year the sales was say 1 lakh and we have made a profit of 40,000. This year up to the death of a partner, that means it is coming to 40% of the sales. This year we have got a sale up to the date of his death. Suppose we have got already 60,000 sales. Sales during the current year up to 73 days, suppose it is 60,000. So, you can apply 40% of 60,000 to be the estimated profit, that is 24,000. Again his share will have to be calculated, that is 24,000 into 1 by 6, that is equal to 4,000. And what will be the entry? The entry is same as it was in case of retirement, that is profit and loss suspense account debited to cease capital account. So, profit and loss suspense account debited 4,000 to cease capital account. In this way this entry will be passed, and as you know, profit and loss suspense account will continue to be shown in the balance sheet till the last date of the year, when the profit and loss appropriation account will be maintained, and at that time we can transfer this amount to the profit and loss appropriation account. There profit and loss appropriation account will be debited to profit and loss suspense account. In this way this profit and loss suspense account will be closed. Anyway, now after the ascertainment of the deceased partner's share of profits, the next special problem is treatment of life insurance policy. Life insurance policy may be individual life policy or joint life policy. If it is individual life policy, say in the name of A there is a policy of 1 lakh, in the name of B suppose 2 lakh, and in the name of C suppose 3 lakh. Their profit sharing ratio is, as we have taken, suppose 3:2:1, and this C has expired. So, what we will have to do is, we will be getting only 3 lakh from the insurance company. On the death of C, we will be getting the entire amount of the policy, that is policy amount, which is 3 lakh. Not only 3 lakh, but also the surrender values of this will have to be taken into consideration. Suppose the surrender value is 30% in each case. So, 30% of 1 lakh will be 30,000 and 30% of 2 lakh will be 60,000. In this way total will be 3,90,000, and C will be entitled to get 3,90,000 into 1 by 6. So, it will be 65,000. He will be entitled to get 65,000 on this, on account of this individual life policy. What will be the entry? The entry will be cease capital account will be created and life policy account debited. To cease account 65,000. This is in case of individual life policy. In case of joint life policy, the premium when is paid by the firm, naturally whenever one partner expires, suppose we have taken a policy for 6 lakh. When one partner expires, here C expires, any one partner expires means the entire amount of the joint life policy will be recovered from the insurance company. So, we will be receiving 6 lakh rupees. Out of 6 lakh rupees, what is his share? We will be taking 6 lakh into 1 by 6. So, he will be getting 1 lakh rupees towards joint life policy. The entry will be bank account debited to joint life policy 6 lakh, then joint life policy account debited 6 lakh to A, to B, to C. In their profit sharing ratio, that is 3 lakh, 2 lakh and 1 lakh. So, in this way he gets rupees 1 lakh. For that you can pass these two entries. Now, let us take one problem on death of a partner. So, here is a problem we will be taking on death of a partner. A, B, C are partners sharing profits and losses in the ratio of 2:1:1. A is to B is to C is equal to 2:1:1. On 31st March 2014, their balance sheet was as follows: A's capital account, B's capital account, C's capital account is given, creditors, bills payable is given. Then goodwill is already appearing at 3000, then freehold property 9000, furniture 1000, joint life policy 2000, stock 5500, debtors 4500 and cash at bank 1000. A died on 1st April 2014, that means just after the balance sheet date, that in the beginning of the next year. The firm had taken a joint life policy for rupees 15,000, the payment for which was received by the firm according to the partnership deed on retirement of death of a partner. The goodwill was to be valued at 1.5 times of the average profit for the last 4 years, and A's share of goodwill is to be adjusted through capital accounts. The profits for the last 4 years were 6,000, 7,500, 9,000 and 9,500. So, if this is the 4 years profits, let us calculate what is the value of goodwill. So, the total is coming to 32,000 and we have to take the average of that profit. Average profit will be 32,000 divided by 4, that is equal to 8,000, and goodwill is equal to 1.5 times of 8,000. 8,000 into 1.5, that is equal to 12,000. So, the total goodwill will be 12,000 and his share will be adjusted 12,000 into that, and previous goodwill of 3,000 rupees will have to be written off, that is obvious. For paying the amount due to A's legal representative or executor, we can say B and C brought as much cash as would bring their capitals in profit sharing ratio, and the firm would have a cash balance of 3,000. So, we have to prepare one cash account. So, record all these transactions and prepare capital account and the balance sheets. So, there are 3 partners A, B, C. Two is to 1:1, that is the profit sharing ratio. The goodwill is valued at rupees 12,000, the total goodwill has been valued at 12,000 rupees. So, we have to prepare these capital accounts, then balance sheet and cash account we can prepare. Let us prepare one cash account. And also the balance sheet. So, again starting with the question, A, B, C are partners sharing profits and losses in the ratio of 2:1:1, that we have already written. Their balance sheet, A's capital account 10,000, that is by balance brought down. By balance brought down 10,000, 6,000 and 4,000. 10,000, 6,000 and 4,000. creditors 4,000 and bills payable 2,000. Creditors 4,000, bills payable 2,000. It is not going to be disturbed. So, in the new balance sheet after that is prepared after the death of partner, we are having those two items intact. Then goodwill was 3,000. Now, when goodwill was 3,000, according to the principle, first of all we have to write off the goodwill to the capital accounts. What will the journal entry? Goodwill account standing at 3,000 in the balance sheet means that is a debit balance. We have to close it by crediting it. Now, when goodwill account will be credited, all the partners capital account will be debited in the profits and ratio of 2:1:1. So, to goodwill to goodwill 3,000 will be there. So, 3,000 divided by 4 or half of it will be 1,500, 750 and 750. In this way, we have written up the goodwill. Then freehold property was 9,000. There is no change in that. No. So, 9,000 freehold property. Then you have got furniture 1,000, then joint life policy is appearing at 2,000. Okay, that will take into consideration. Joint life policy account is having 2,000 debit balance. All right. Then stock 5,500. Stock 5,500. Debtors 4,500. Cash at bank 1,000. Two balance brought down 1,000. A died on 1st April 2014. The firm had taken a joint life policy for 15,000, the payment for which was received by the firm. Now, when the joint life policy amount is received on death of A, the entry will be bank account debited to joint life policy 15,000. So, cash or bank account debited to joint life policy 15,000. So, joint life policy was debited 2,000, now credited 15,000, means there is a debit balance, credit balance, net credit balance of 13,000. Okay. Then that joint life policy account which is showing a credit balance of 13,000 will be passed on to the capital accounts of the partners in their old profit sharing ratio, and the old profit sharing ratio is 2:1:1. So, the entry will be joint life policy account will be debited and this partners capital account will be credited by joint life policy account. Out of 13,000, 6,500 here and 3,250, 3,250 to B and C. Then we have already dealt with the joint life policy, then wipe it out. Now, next one is according to the partnership deed, on retirement of death of a partner, the goodwill was to be valued at 1.5 times, that we have already done. Goodwill account is 12,000. Now, this account will have to be adjusted through capital accounts according to the instructions. So, 12,000 means what is his share? His share is 2/4 into 2/4 is equal to 6,000, and these 6,000 rupees will have to be credited to his capital account. His capital account is credited by you can write by B by C. How much? 6000 in the gaining ratio, that is 1:1 again. So, A account will be credited by B, this is towards goodwill, 1000, sorry, this will be 6000 means 3000, 3000. The entry is B's capital account debited, C's capital account debited to A's capital account. So, A's capital account has been credited by B and C. So, B and C will be debited to A for goodwill, this is 3000 and 3000. This is towards the goodwill. Then, for paying the amount due to A's legal representative, B and C brought as much cash as would bring their capitals in profit sharing ratio. Their profit sharing ratio is equal 1:1, and the balance in the cash account should be 3000. It means you have to get a debit balance of 3000 here, two balance brought down. So, if it will be by balance carried down 3000, then only it will be possible, and once it is possible you can take it here, cash or bank account 3000. In the new balance sheet prepared after the death of A, you can have this balance sheet where cash account will have to be shown at 3000. Okay, now what is the amount due to him? First let us determine. First of all, A's capital account will be closed, 500, 22,500, so he needs 21,000 to be taken. To cash balancing figure 21,000. So, cash account will be credited by A 21,000. So, all total requirement is 24,000, 21 plus 3. Out of 24,000 we have got 16,000. Out of 24,000, if we have got 16,000, 24,000 minus 16,000, that is equal to 8,000 will have to be brought in by A, by B and C. Now, let us see what are their balances. Their balances are, now who will give how much? How much will be given by A, sorry B, and how much will be given by C out of this 8,000. That is the only thing to be seen. So, here let us see this side 3,750 and 3,750. We can write the credit balances of B and C are 9,250 and 7,250. And debit balance are 3,750 and 3,750. In this way, they are having a net credit balance of 5,500 and C is having a net credit balance of 3,500. So, if their capital will be equal, how much they will have to bring? Because he has got more debits, I mean B is having a credit balance of 5,500, C is having 3,500. So, total if you add, it will be coming to 9,500. 3,500 and 5,500. So, out of 8,000 there is a difference of only 2,000. The difference between the two is 5,500 minus 3,500, that is 2,000. So, we can do one thing, out of 8,000 minus 2,000 is equal to 6,000, and everybody will have to give 3,000 and 3,000. And the balance not having 2,000, that means this net credit was C was having only 3,500, already B is having 5,500. So, excess 2,000 will have to be borne by or brought by C. So, in this way C will bring 5,000 and B will bring 3,000. C's capital account will be created 5,000 and B's capital account will be created with 3,000. The entry will be cash account debited to B 3,500, sorry 3,000 and to C 5,000. In this way it is coming to 24,000. Now, this entry we can incorporate here. Cash account debited to BC means by cash B 3,000 and C 5,000. In this way the total is coming to 12,250, 12,250, 12,250, 12,250. So, 12,250 minus 3,750, 12,250 minus 3,750 will be 8,500. So, two balance carried down, $8,500 and here also the same thing 8,500. So, it is coming exactly in the ratio of 1:1. So, by balance brought down, $8,500, $8,500, which will be placed in our balance sheet. Capital account B 8,500 and C 8,500. Either he takes cash 21,000 or it will be converted to a loan account 21,000. Then it is coming to so both the sides total are 23,000 in the balance sheet. So, that is the way in which we have to work out the problems on death of a partner. So, what we have done today is, first of all, we are determining the capital accounts of ABC. That is your I mean profit sharing ratio of ABC. Three partners were there. Out of them, A is expiring, A's death is there. So, what we have to do is, we have to take into account his capital account and that will be converted to either loan account or he will be given cash. That is one thing. Second thing is, in the question it has been given that on the average goodwill will have to be valued at the average profit made during the last 4 years multiplied by 1.5. So, what we have done is, we have calculated the profits of 4 years, added it, divided by 4, so that it was coming to some 8,000, and on 8,000 we are multiplying it by 1.5. So, it is coming, that is 1.5 years purchase of 4 years average profit, that was the language. So, it was coming to 12,000, but 12,000 is the total value of goodwill. Out of 12,000 we will be giving 2 by 4, 2 plus 1 plus 1 is equal to 4. So, out of 4 shares, 2 shares belong to A and A will be entitled to get 2 by 4 or 1/2 of 12,000, which is 6,000. For that he will be getting a credit of 6,000 by goodwill by balance brought down. This we have taken then by joint life policy by BC goodwill, he is getting 3000 and 3000 because it is adjusted through the capital accounts. B and C's capital account debited and A's capital account is credited for this 6000. Then we came to, there is no revaluation. So, revaluation account need not be prepared. Only thing is there is an adjustment of joint life policy and ultimately the cash account, that is for making the capitals according to the new profit sharing ratio between B and C. So, first of all, coming to the joint life policy, already joint life policy account was appearing. We can create one joint life policy account also for your purpose. Joint life policy account to balance brought down in the balance sheet, it was appearing at rupees 2000. So, 2000. When A dies, we are getting full amount, that is the policy amount was 15,000. So, we are getting 15,000. So, if we are getting 15,000, the entry will be bank account debited to joint life policy account. This is the entry, cash account debited to joint life policy. So, joint life policy account will be credited by cash 15,000. Now, out of 15,000 already 2,000 debit is there. So, 13,000 is remaining, that is the profit on joint life policy due to the death of A will be 13,000. That 13,000 rupees belongs to A, B, C, all three partners, and that will have to be shared in the profit sharing ratio of 2:1:1. So, that will be joint life policy account debited to A, to B, to C. How much? Here it is 6,500, 3,250, 3,250, 6,500, 3,250, 3,250. In this way, the total account will be closed. This account will be closed. Joint life policy account is closed. After joint life policy account, only one thing is remaining, that is cash account. He is telling that you have to keep a balance of 3,000 ultimately. So, two balance brought down first of all will write. This two balance brought down will be possible only if by balance carried down 3,000 will be there. So, now A, we are closing first of all A's account. A's account is already ticked down, that is 22,500 credit and 1,500 debit. So, remaining 21,000 balancing figure will be taken by him in cash or it will be converted to loan account. So, this 21,000 rupees if we give cash, then by A 21,000. In this way we require 24,000 total, 24,000 here. So, 15 plus 1, 16,000 is already with us, 1,000 was there with us, 15,000 we have received from the insurance company joint life policy. So, 16,000 is there, another 8,000 rupees will have to be brought in by the remaining partners B and C. Now, B and C are having how much of capital, that we have compared, that B is having more credit than C, net credit I am telling. 6 plus 3, 9,250 minus 3,750, and here C is having 7,250 minus again the same 3,750. So, naturally the credit balance is more in case of B by 2,000. So, that 2,000 rupees extra will have to be brought in by C. So, out of 8,000 you keep aside 2,000, that will be given by C, and the remaining 6,000 equally will have to be brought in, that is 3,000 and 3,000. So, in this way B has to give 3,000 and C has to give 3,000 plus 2,000, that is 5,000. So, these 3,000 and 5,000 you can keep it here and it will be okay. Now, this after getting this you can close the accounts. The credit side totals are 12,250, 12,250. Out of that whatever debit balances are there, that is 3,750 each for B and C, deduct it and that will be two balance carried down 8,500, 8,500. This is the ultimate balance, by balance brought down for B 8,500, for C 8,500. That is the capital account standing to the balance of B and C. So, that will be brought to our balance sheet, liability side, capital B 8,500, C 8,500. we have taken all the other items from the previous balance sheet and then we have incorporated this one. The cash account is newly brought to 3000 from 1000. Now, you make the total and we are getting 23,000 rupees in both the cases. That means, apparently the problem is correct because the balance sheet is tallying. Thank you. This is all about your death of a partner.